Hello, everybody. It's great to be here today. With me today is Matt Dmytryszyn of Telemus. Matt is the CIO, as Justin mentioned. Matt, why don't you just talk a little bit about what you do and why the reason I had we had invited you to be here today.
Yeah, so I lead the investment team at Telemus. We're a $3.5 billion investment firm, registered investment advisor out of Southfield, Michigan. And so we work with clients every day, individuals, and helping them to manage their wealth. So I lead the investment team and help direct our investment strategy, follow the economy, dig into markets, and just have probably one of the greatest jobs around. So, and got introduced to Marc as through our relationship with Telemus, and just got to be lucky to meet an insightful individual who's got great business experience, and just all around an amazing human being. So thrilled to join you today, Marc.
Well, thrilled to have you. Thank you. You're very kind. So I like Matt because he's got an encyclopedic knowledge of finance, and he's extremely thoughtful and is very good at understanding how the market moves, all markets, that is, and spends a lot of time, looking at that. And I think that, whether you're, everybody takes risks, whether it's in your own personal balance sheet or in your business, you're taking risks, and how you feel about the economy has a lot to do with psychologically the amount of risks you're going to take or how averse you are to risk. And they talk about the consumer and the consumer psychology and how the consumer sentiment exists at a given time. Well, business sentiment is even in some ways, I think, much more important because businesses are the ones that really invest tremendously in the growth of the economy. So how you all feel about the risks you're going to be taking is important, and it changes as economic cycles change. So we thought that talking about those and strategies you can do it that are available in retail for different cycles is also a good discussion. But we're going to lead it off with Matt's prepared some really interesting charts for us to look at, and Matt, go for it. Thank you.
Well, thanks, Marc. Let's maybe kind of set the table at kind of the big picture. Just what's the broader economy doing? If I look back a year ago, the consensus of all the various economic prognosticators out there, I would admit myself included, was that 2023 we'd enter the year in okay footing, but by the back half of the year we'd enter a shallow recession. And the thought process around that was in 2022, if you remember, the Federal Reserve started to increase interest rates and did it in a fairly aggressive manner. They were continuing that going into 2023. And the thought that typically there's a 12 to 18 month lag between when the Federal Reserve raises interest rates and when you start to feel the effects on the economy. So the thought would be, well, in the back half of 2023, we're going to feel those effects. Couldn't have been more wrong. The third quarter of 2023, the U.S. economy grew almost 5%, very massive level. On Thursday, we're going to get the GDP growth number, or how the U.S. economy grew in the fourth quarter. And the expectations are that'll probably be around 2.5%. So the economy maintained its growing trend and was quite robust throughout 2023. As we enter 2024, the expectation is we're going to continue to maintain a growing economy, but the rate of growth is going to start to moderate. And so you can kind of see these green charts here where we're kind of, and this is all the economists that are out there, that this is Bloomberg, a financial services provider, and this is the economists they surveyed. And it just kind of shows a slowing rate of economic growth here as we work through 2024. Now, if we move on to the next slide, and we think about, I think we jumped ahead one. There we go. And if we actually think about kind of, well, what's driving kind of the comfort in the economy, it's the labor market. And so if you look back a year ago, there were 2 jobs outstanding for every unemployed worker. So that chart on the left, the vacancies per unemployed person, that's gradually whittled down. It's at 1.4 job vacancies per unemployed person today. But if you kind of look back prior to the pandemic, it was kind of moved up and down, but it was typically, 1 job available for unemployed person. A reason why we've really had this big shift in the labor market where it's hard to find workers, where we have a challenging labor participation rate, is really a demographic thing. And it's particularly those individuals 55 and older. So prior to the pandemic, The cohort of workers that were 55 and over, about 40, a little over 40% of them were in the labor force. Today, it's about 38.5%, or almost a 2% reduction. The flip side is 25 to 54-year-olds. Those individuals are actually pretty active in the labor market. In fact, earlier in 2023, we had an all-time high in terms of labor force participation among individuals in the 25 to 54-year-old age group. So it's not like people aren't participating. It's just we had a lot of people retire during the pandemic that haven't gone back to work. That's creating a structural imbalance, and it's really creating a labor market that it's still hard to find workers, but people feel safe in their jobs and they don't feel that they have to worry about getting laid off or getting fired. And that's really supporting the economy. People are willing to spend and continue to spend if they have a stable job. Taking that a step further. Yeah, go ahead, Mark.
I'm sorry to interrupt, but two things. One thing we forgot to mention was this is a live webinar, so questions, and feel free to post your questions in the Q&A, and we'll address them after this. And then the second thing is, you were talking about people during the pandemic that were older decided to leave the market, or leave their jobs rather. Yet they must have the financial ability to stay unemployed. So that's interesting to me as well.
It is, and it's a good point, Mark, because I was starting to scratch my head after 2022 when we had a bad stock and bond market. Are people going to come back into the labor force? And they didn't. We didn't see that. So
right.
It's a good point.
So I'm sorry to cut you off.
No problem. And if we kind of move to the next thing, taking that a step further, if you're comfortable in your job, that also gives you, and it's hard to find workers, that gives negotiating power to workers to get higher wages. And so when you look at this chart, the purple line is the wage growth, and this is kind of average wage growth over time in the U.S. economy. And prior to the pandemic, it was kind of in that 2 to 4% range pretty regularly. And now it's elevated. It was up over 6% at one point in late 2022. The colors in between also measure inflation and what in the economic speak is real wage growth. Real wage growth takes what you actually get for higher raise, if you will, and then takes out inflation. So it's how much do you have left after you've paid higher prices. And the challenge workers faced, and every individual faced in 2021 and 2022, is we saw inflation peak in June of 2022 at 9%. So if I got a 6% raise, but everything I pay for is up 9%, I have 3% less in my pocket after all things equal. Now, as we move forward to today, wage growth is about 5%, but inflation's back down closer to 3%. So I'm still able to pocket the difference, or that 2% in my pocket. So we've had this shift that's really only come into play over the last 6 months, where we've seen positive real wages come back into the fold. So that's a positive thing. But that really depends on where the direction of inflation is going. So let's talk about inflation for a second. If you mind moving to the next slide here, Justin. So this is an interesting chart. I'll admit it's I borrowed it from Apollo and their chief economist. It's a little bit of a scale difference, but it's very interesting when you look at it. So the darker line looks at the inflationary cycles that we saw from the late 1960s through the early 80s. And what happened then is we actually had 3 different kind of inflationary cycles: a pretty moderate level of inflation in the late 60s, a more meaningful uptick in the mid 70s, and an even more aggressive uptrend in inflation in the late 70s into the early 80s. That's really ties to the axis on the right-hand side. The axis on the left-hand side ties to the green line, which is what we've currently been going through beginning in 2014. And so we had a little bit of an inflation bump when energy prices rose in the mid part of the 2010s. And now we've had another elevated bout of inflation. And so the question is, are we permanently done? And the nice thing is we've gone from 9% inflation to 3%. But the question is that truly something in the past, or do we have a risk of more inflation on the come? My view is I'm not really that worried about it in 2024 or 2025, but I do worry in the back half of the decade. I think there's a risk that we could see another elevated bout. It might not be what we saw in the 70s. It might not get back to 9% or even worse. But when you think about kind of what's gone on, we got, during the pandemic, I'll take real estate as an example of kind of what could drive this. So during the pandemic, college kids, younger adults, they moved home with their parents. Other people, as they were laid off, maybe found other places to live, and so there wasn't as strong a demand for new apartments, new housing. Pandemic's over, we get vaccinated, people want to go on with their lives, they move out of their parents' home and the like, and all of a sudden demand for apartments was very, very strong. And we saw rents going up double digits in late 2022, late 2021 into 2022. That prompted developers to go, hey, wait a second, rents are pretty high here. There's a lack of supply. Let's build new units. All that supply came on in the back half of 2023 and into 2024. But if you actually look at new projects in construction in various phases of construction, new construction, there's not a whole lot of new supply of apartments that are going to come online in 2025. And so that'll gradually absorb all the new supply that comes on in 2024. And by the time you get to 2026 or 2027, if you have a healthier economy, there might be more demand for new housing units, new apartments. We have a structural shortage of housing that's going to lead to higher rents, and you'll get another inflationary cycle. And as you're building more units, it's going to be more demand for lumber and more demand for other commodities. So we could have another inflationary cycle. There's a lot of scenarios and a lot of assumptions that would go into that, but it is something to kind of keep in the back of your mind. But we think in the short term, there's, I think, a softer economy. There's not as much excesses in the economy, and I think that'll keep things at bay, at least as we look to 2024. So that's kind of the bigger picture. Yes, Mark.
I have a question. If inflation is at 9% in June and 3% in November, December, January, does that mean prices drop 6%, or are we still supporting that 9% increase? Does that carry forward?
Yeah, it's a good question. No, we're still supporting that. That it's just the rate of price growth is now only 3% instead of it was 9% back in June of 2022. So the prices haven't gone down. That would we'd have to see that as a negative inflation number or a minus, 3% GDP to actually show that, or CPI to actually show that prices would be declining.
Right. So if you talk about real wage growth, does that take that into account? So if wages are now equal to or greater than inflation, does that create more disposable or income for workers or for, disposable income or savings? Does that change anything?
Yeah, it's a good question. I would say using like year over year metrics, yes, because I got a 5% raise over the last year and inflation's only been 3%. I actually have more money. I have 2% more money. If you look at it in aggregate, going back to call it the end of 2020 through now, I think the numbers would tell you the amount of inflation is still higher than the amount of wage growth, but it's starting that amount is starting to narrow.
Right. All right. Thank you.
No problem. Kind of shifting gears, I guess, now to kind of focus a little bit more on the consumer, because there have been some interesting trends that have gone on, and a lot of kind of economic, I guess, terms here, but I think it kind of helps show what kind of some of the trends are. So when you kind of look at what people consume, you can kind of put them in 3 broad buckets. Durable goods, so that would be things like furniture, appliances, cars, automobiles that are truly durable. You can't break them that easy. You can't use them that quick. There's non-durable goods, which would be food, household products, things that you kind of use once or consume once and you're done with them. And then services. So that would be travel, hotel, restaurants, those types of things, ballparks, going to the ball games and movie theaters. And so what we saw during the pandemic was, okay, everybody goes home and quarantines. The initial spurge was, okay, now I'm going to be sitting at home all day long. I need to get new laptop. I need to redo my office. I need to get a nicer couch because I'm sitting and watching Netflix all the time. So you saw, and I can't go to the movie theaters anymore. I can't go to bars and restaurants. And so spending on services slumped and spending on durable goods picked up pretty significantly. You get past the vaccines coming out in the spring of 2021. There was another wave of durable good orders as people were remodeling their homes and doing other things. And then since then, it's kind of ebbed along. And it's actually, if you look at the chart on the right, that's kind of just zooming in on the chart on the left, but focused more over the last 2 years. And so you've really seen that green line, which is durable goods, just kind of ebb and flow. There hasn't really been much of a tick up or growth. What's happened is I think we all kind of know is people have shifted more towards services. They want the experiences. They no longer need a new refrigerator, a new couch, but they want to go to the ballpark. They want to go down to Disney World. They want to go out to bars and restaurants. They want to go to the movie theater. And so we're seeing elevated levels of growth in spending on services. The purple line takes a little bit of explaining. That's your non-durable goods. That's really all inflation related. So you can see the double-digit increase in spending on non-durable goods at the beginning of 2022. But if you remember, that's when gas prices spiked. That's when food prices spiked. Year over year, inflation in food prices was double digits at that point in time. So that's what's driving that. The nice thing is that inflation on those non-durable goods has come down. And quite frankly, food prices now are, and even on the raw materials into food prices continue to come lower. And so that's become less of a category where consumers have needed to spend as much more and has enabled them to continue to spend on services. On services, you kind of see that trend coming down, but it's still elevated, kind of more of a moderation in activity. And so I think, if I kind of summarize all this during the pandemic, the pendulum swung very strong towards goods and particularly durable goods. Coming out of the pandemic, really the last 2 years, it swung to the other side, very much in favor of services. And we're slowly starting to see it move back towards equilibrium, where consumers are kind of getting back to their normal spending patterns between goods and services. Not quite there yet.
So is there a forecast for that when the consumer, I mean, part of it's got to be emotional. I was cooped up for 3 years. I couldn't do anything, I'm just going to go out and go on trips and go to restaurants. Do we see that flipping or
we have, but it's going to be in bits and pieces, I guess. So it's interesting. You've seen some of the travel and things like that start to slow, or the rate of growth slow, but then you've had things like healthcare has started to really grow. So healthcare flows into services. People are doing more elective procedures and the like on that side. On the goods side, we've seen things moderate. And so furniture was pretty bad for a while. I shouldn't say bad, but it was decelerating. Now that's starting to kind of level off. But strength in recreational goods is still pretty strong. So people are still out buying new golf clubs or tennis rackets or bikes and the like on that side.
Well, we even see that in, a lot of categories that are travel oriented, they continue to do well and spike and perform well. So it makes sense.
Okay. If we kind of the next page, if we kind of look at how are consumers affording all this spending? And so I kind of think about it in my financial mind in terms of the consumer's balance sheet, their assets and their liabilities. So on the asset side, they've been in really good shape, but it's starting to moderate. So during the pandemic, consumers aggregated $2.1 trillion of extra savings that they normally that was kind of above and beyond their savings rate going into the pandemic. And that came from two sources. First is you were staying home, so that taking the family to Disney World didn't happen, so you ended up saving that money. And the second piece from the stimulus payments that came from the government as well. So what we've seen is that kind of peaked at that 2.1 trillion in the middle of 2021. And that's been slowly winding down as that money's being spent. And so per the San Francisco Federal Reserve Bank, they estimate about 290 billion was remaining of that excess savings as of November. So the expectation is the first half of this year, that probably is gone. The other piece is people are just saving less out of their regular, weekly, biweekly, monthly paychecks. Historically, the average savings rate is 8.6%. We're currently at 4.6%. Earlier in 2023, that had gotten below 3%. And so people are just electing to save less. So one would argue, and we've seen this before, so I would actually kind of point back to 2005, 2006, 2007. You can see on this chart, the bottom left chart, the savings rate there was kind of around 3% for 3 years. So the savings rate can stay low for an extended period of time, longer than one might expect, but it tends to kind of revert back towards, 8.6%, kind of included the 60s and 70s where the savings rate was higher, but 7 to 8 is what I kind of ballpark as kind of more of a normal personal savings rate. So we would expect at some point in time, people going back to savings more of their money. That could come from that real income growth. They just get more in their paycheck, they choose not to spend it and they'll save more, or it could come from them cutting back their spending. We're not seeing that at this point in time. And like I've said, that can go on longer than people expect, but I think it's something to be aware of. If we move
the Apple Pro Vision is already sold out at $3,500.
Yes.
So I don't know, maybe that's coming out of savings.
We're not saving it yet.
But if people want something, they're going to buy it, right?
Yes, exactly. On the liability side, I'm actually going to start with the chart on the lower left first. That's actually growth in credit card balances. So a little bit eye striking, but I think part of it is, coming off such a low level in 2021 where people didn't have a need to draw on their credit card. We've seen, growth in credit card balances. And so that's sporadic, but we are starting to see that increase. And so that's a sign that some consumers have spent through that excess savings and they've been putting more on their credit card. And, some may be getting tapped out at some point here. But in aggregate, I would say it's not excessive, but it is something to call out. The other piece on the liability side is this chart at the top, which is the household debt service ratio. I would say one piece of it is misleading is this takes everybody. So if you paid off your mortgage, you're in here. If you just put on a brand new mortgage, you're in here. But I think the direction of the numbers is helpful. And it basically says the average consumer in aggregate pays about 10% of their income towards debt service. So that would be for your mortgage, for your credit card, for your auto loan or whatever. And that's fairly low relative to history. You look at kind of throughout the 80s into up through 2020, low double digits was the average rate here. We're kind of sitting right at 10%. So that's a good thing in that consumers are having more money to spend on consumption than just paying their debt service. That's a good thing. But I think my thought would be it's going to slowly start to change and slowly start to move higher. And if we get to the next chart, I'll talk you through why. One of my favorite charts, Justin, can you move forward one? Here we go. One of my favorite charts is this one on the left here from Redfin, the real estate website. And so what it tries to do here is take a person making the median income and said if they went out and bought the median home price, how much of their income would have to go to paying their mortgage? And for up until the last 2 years, forever, that was right around 30%, maybe a little bit below. But because we've seen strong home prices over the last several years and now interest rates up considerably, that person that makes the median income buying the median home would have to pay 41% of their salary, of their take-home income towards covering their cost of their mortgage. And so that's a challenge. And so their debt service is going to go up higher slowly over time if people buy homes into the current rate. In fact, yesterday there was economic data that came out and showed the existing home sales were at their lowest level since 1995. So the good piece of that is not a lot of people are moving. So not a lot of people are taking on mortgages at 6.5% or 7% or wherever they sit today, which is a good thing. But we know over time people have to move, they choose to move, whatever. And if interest rates don't change, that is going to be a hindrance on consumers' ability to continue to consume, but it's going to be kind of one at a time. We'll talk about that a little bit later. Another interesting anecdote is just on the auto loan side. So auto loans are at their highest level in 20 years. So if you're paid off that car, decide to go out tomorrow and buy a new car, you're going to have a little less discretionary income because your auto loans rate's going to be higher, and you may pay $100 or $200 more a month just to service your auto loan. So something to be aware of. I think that's going to be a slow, gradual change, consumer by consumer, in terms of their liabilities and their cost of financing it.
So Matt, what about all I would think the majority of people who own homes at, mortgage rates that are, even under 4%. I mean, how does that impact the wealth of the country and disposable income?
I think it's a great thing right now because it means they're fairly like that 10% of their income's going to their debts to cover their debt costs. And so as long as that kind of stays there, I think we're in great shape. It's just a question of, will that stay there or will that gradually change, which kind of leads to this chart a little bit. And what I kind of want to highlight is this is the federal funds rate. This is the rate that the Federal Reserve sets. So when you read in the newspaper, the Fed cut interest rates, they're not cutting the rate on a 30-year mortgage. They're cutting their rate on the federal funds rate, which is what banks lend to each other on an overnight basis. But the federal funds rate informs other interest rate metrics. So like a 30-year mortgage tends to be based on what the yield you can get on a 10-year treasury bond. And 10-year treasury bonds factor in what they think the federal funds rate is going to be over the next 10 years. So it has an influence on that. But a key part of this is if you look at from 2008 through until 2022, so that 14-year period, for a bulk of that period of time, outside of a couple-year period there between 2016 and the end of 2018, interest rates were at zero. And so going back to your point, Mark, those people that have a 3% mortgage, our view is unless we have some unexpectedly bad things happening in the economy, I don't think we're going back to 0% interest rates. And so I'm not sure we're going to go back to a 3% mortgage. And so it's great that you can stay in that 3% mortgage for an extended period of time, but eventually if you do move, you're going to have to take on a mortgage at a higher rate. It might not be at 6.5 or 7% where we're at today. It might be at 5.5, but it still is going to lead towards higher debt service cost, but it's going to be, again, consumer by consumer as they make that move. So I think that's something to kind of keep in mind.
So do you think that's going to stall people moving? I mean, they're just going to elect
I
to,
do.
probably, refurbish, put some improvements in their homes rather than, unless, they have to move for a job or something.
Correct.
But other than that, it wouldn't make any sense to give up, that spread, because that's significant dollars. So,
Significant.
3 or 4 or 5% interest points is a significant amount of dollars over time. Even if your home would appreciate it,
Yes.
you're just giving all that money back.
Correct. You're spot on, Mark.
Yeah.
You're spot on. So that's kind of what we see kind of in the economy. If we kind of take it all together, the next slide is kind of more on just, well, what do you expect from an expectation standpoint? We kind of see some headwinds and tailwinds. I think that message I've kind of talked about a little bit earlier is it's in moderating. The economy is in good shape. We feel good about that. And I think a really strong labor market is really important to the strength of the economy, and we're in great shape there. But there's going to be some headwinds and tailwinds that lead to that moderation. So those tailwinds are, wealth effect. And Mark's pointed this out to me. We had a very, very strong year in financial markets. Stocks were up over 20%, bonds were up, and people feel pretty good about their personal balance sheet. So I think that's helpful. There was some academic research out there that kind of says on average about 10% of what people make in the markets tends to actually get put back into their spending patterns. So not massive amounts, but I think people will feel a little bit better spending because they made some good money last year. We have that positive real wages. So people are making more and they're putting more money in their pocket net of inflation. That's a good thing. I think there is that kind of more we're getting back closer to that equilibrium between spending on goods and services, and some of the extremes that we see stemming from the pandemic are starting to work through the economy, and slowing rent growth. I think just we had pretty sizable rent growth. So people that were renting their homes or in apartments, they were paying double-digit rent growth in late 21 and 22, and as that's starting to ease, I think that's giving people a little bit more comfort to continue to spend more. But on the flip side, some of those excess savings are starting to work through the systems. The debt costs are starting to go higher. Again, it's going to be kind of consumer by consumer. I think another thing I haven't really talked about is a nice tailwind over the last year has just been lower energy prices. As you're paying less at the pump, you got 20, 50, $100 more in your pocket at the end of the month. And I'm the last person that's going to prognosticate on the price of energy and oil. I think it's really hard to forecast that. But I think it's also important to realize maybe some of that tailwind from having lower gas prices is maybe gone. Maybe at some point we will get higher gas prices. I don't know if that's going to be this year or not. There's a lot going on in the Mideast that can drive it one way or another. But I think it's important to keep that in mind. I think in aggregate, what this leads me to kind of conclude is I think the consumer's in good shape, but I think their behavior is really going to be consumer by consumer dependent. If Mark and I have the same spending patterns, we make the same income, but Mark refinanced his house in 2021 at a 3% interest rate, and I just bought a new home at a 7% interest rate, I'm going to have less money to spend than Mark's going to have. Or if Mark just went out and bought a new car, and I'm keeping the car I've had for the last 8 years, Mark's going to have higher interest costs as he goes and refinances into a newer car. And so I think it's going to lead to each consumer as they make those decisions, that's going to slowly impact their individual spending patterns. And I think we'll just see a more bifurcated spending habits and disparity in consumer spending. So those are kind of my thoughts on the economy, Mark. I mean, how would you apply this as an independent retailer?
Yeah,
your strategies.
So I don't know, we need to go back a slide here. Right, we're missing a slide. Go back. Next one. Yeah, there we go. So when I think about, there's a lot of parallels that I could draw between, how I look at the retail business and how, financial advisors look at different categories. There's fixed income, there's equities, there's alternative investments, there's cash. And within those, there's classifications too. And you're always moving those around based on how you see the economy and predicting the, and also your risk tolerance. So there's tremendous parallels between, how you manage money and how we manage what one manages inventory. So I looked at it as four major classification strategies. Go on a treasure hunt, cull the herd, which I'll talk about, skill growth. And I think that one of the things that we need to be thinking about is how we improve our skills, how we become better leaders, better managers, because that all equates to increased productivity. And productivity is what drives profit. And I think it's an area that never gets looked at or talked about much, but I think it's an important consideration. Creating memorable experiences. I'm going to talk about that because I think, one of the things that we saw after COVID was everybody thought brick and mortar was dead and everybody was just going to shop on the internet because that's what they had to do when they were shut down, especially. And it was quite the opposite. I mean, people flocked back to brick and mortar. They wanted to have, they want to be engaged. And that's something that's not going to change. So I do think that you can enhance that through memorable experiences. And then the other part that businesses need to think about is you need to work on the now and on the future at the same time. I'm going to give some examples of that. So let's go on a little treasure hunt. And this is true story. I randomly picked a client out of Management One's enormous database. I just started to scroll down and picked one and ran a performance report. And in the highlighted yellow, these are, I don't know, I probably picked a pretty good client here. But if you look at the highlighted yellow, I looked at the relationship between what they landed at retail and what they sold. And then I looked at their margins. Was it driven by markdowns or was it profitable? And if you look at sweaters, for example, they landed $283 and they sold $312, or it cost $128. So it's highly profitable. And then the next one in t-shirts, you have the same thing. They literally sold more than they landed because they had existing inventory from the previous year. So your question is, what would happen if I took a risk and invested a little stronger in some of these categories? If you look at shoes, for example, it's in red. Granted, they brought in 20 and did 19, but their markdowns were 26%. Their margins were 43%. So the question is, why even bother with a $20,000 a year class? What would have happened if we would have invested the $20,000 in retail, even split it up between sweaters and t-shirts? You would have made more. You would have done, I'm guessing it's a reasonable conclusion that you would have done more business and you would have done it more profitably because those were in demand and those are things that, customers are looking at. So, part of the strategy is go on a treasure hunt within your own classification system, look at what's working, look what's not working, and think about those investments. And then, also be looking at what's trending. And this is true, you can go through each one of these and have a strategic conversation, looking at what I did well, what could I have done better? If I invested another 5 or 10,000 and did another 10 to 20,000, what would that look like in terms of revenue growth? Because a lot of that's just sitting there to be taken advantage of from your existing customers. So in this case, if you looked at the majority of classes which are doing well, and they each increased by another 10 or 20,000, you're probably looking at putting another 150 to 200,000 just in sales that would be profitable without, a lot of, sweat. Next slide. Cull the herd. I mean, I think this is one of the most important tactics that a retailer can do, especially going into the new year. Identify the key number of vendors in each classification. If you have more than 3 to 5 vendors in any classification, you run the risk of duplication. So be very careful. Then the customer ultimately makes a decision on which vendor they like the best. And then the rest all go to markdowns. And all you've done is you haven't improved the assortment. You've just confused the assortment and given it to the customer to decide. And you're going to end up with heavier markdowns. Doesn't mean you shouldn't test vendors or bring in new vendors in a classification, but they should be a vendor that adds to the mix, doesn't duplicate the mix. And I think that's important. And I think retailers tend to go back to the well too often. And then, obviously look at what your success with your vendors was and run a vendor scorecard. You can go on the Management One website and get that. It's under resources, I believe, and run sales by style and treat each color as its own style. because color is super important today. I mean, if you look at, one of the best-selling shoes is the Boston by Birkenstock, and it's one color that drives all that business. I think it's a taupe beige. So run it by class by vendor and make sure that you're also looking at color, because color is important. And in certain classifications, color is more important. And as you're building your assortments out, be thoughtful about that. Or if you're taking what you've bought in the past and you're looking at what you can match it to what you want to buy in the future, having that information along with size is critical. Next slide. Create memorable moment, skill growth. So I talked about this. Most independent retailers or founders, they, run their own businesses. And I think I think one of the things they overlook is how important leadership training is, because you're there to, avoid blind spots. I have a blog, I'm going to pre-sell my blog, but I have a blog coming out that I've already written, that I've adapted from another blog that I have permission to use about the blind spots leaders make in making decisions. And to the extent that you don't make those mistakes, you avoid losing money. So you want to always engage in leadership. Business maturity and leadership is important. And being engaged in and learning from it and investing in yourself and your team, and it will pay dividends. Plus, you'll recruit more of the kind of people you want to recruit, because they see that you care about teaching your people to be better at what they do. So it helps, and it's also part of a mindset. So mindset should always be about, how do I get better at what I do? I mean, you look at all the great athletes in sports today, and the one thing they all talk about is their coach, how much time they put in to learning to be better at what they do. Any interview after any game, they thank their coaches first. Well, there's a reason for that, because they study film, they study what they do, and they study to be better. And the people, the retailers and I know I'm spending more time on this than almost anything else, because that's how strongly I believe in skill growth and skill training. And then part of it is becoming a teacher. I mean, there's this Founders podcast, which I would encourage everybody to listen to, because the Founders podcast, the fellow that runs it is extremely motivational. He reads these biographies and condenses them and talks about them, but they're highly inspirational because they talk about individual entrepreneurship and the obstacles they had to overcome. And one of them, he talks about the fellow that runs Costco, and he learned from Robert Price, I think his name was, who's really the first discount person. And he said, you train animals, you teach people. And that really stuck with me. And there's a difference between training. Teaching is really getting in there and working with people and showing them what you would do if you did it, so that they could become better at it. So become a teacher, don't just become a trainer, and make sure your people really learn. And if you're not a good teacher, invest in becoming one, or hire somebody that can do it for you. It'll pay massive dividends for you. So don't think about the expense of it. Think about the result you can get from it. Next slide, please. Create memorable experiences. For those of you that have a POS CRM or don't, I can't, and Justin could probably speak to this better than me, but I saw what a CRM did for Management One. But knowing the data on your clients is critical. And it helps support your people, because they have the information they need to be able to work with they understand what's going on with the inventory, and they understand what's going on with your clients and your customers. So, and part of that is just making sure that you're doing things in your relationship to make it advantageous for the customer or the client to want to return. Many of Management One clients do a great job of that through hosting events, being involved in their communities, being supportive of local charities and those kinds of things. But keep your foot on the pedal, because those memorable experiences are important. And if building a relationship isn't important to the people that are in your store, and they're not helping fuel that, then you're potentially looking at a competitor that you don't know about, and those are always the most risky ones. And so, and I'm going to kind of talk about Nike a little bit. I remember in 2017, a lot of our bigger, especially in the elevated streetwear space, they were saying, listen, Nike's going to they're going down to 40 retailers that they're going to do business with. And we need to be one of those. And they're basing it on those retailers that really create memorable experiences. So this was in 2017. So, nobody wanted to lose that Nike business. And I'm glad to say that the clients that we worked with that were tier one retailers, Nike stuck with them because Nike learns too. But today, Nike, 50% of their business is on e-commerce. But what they've learned, and they're building their own stores, but what they've learned is the customers who have been in the stores or had the good experiences in client stores, what they buy online is 30% more than the customers that haven't. So creating those memorable experiences is really critical. And a key to that is being creative and being willing to think out of the box. And, as the owner and the founder, you don't have to have it. Some of the best ideas will come from your people, and your customers. So be thinking about how to be creative and don't put the pressure on yourself to come up with, all the ideas all the time. Just listen to what your people have to say and listen to what your customers are thinking about. And, when you go out to market and you go into other towns for market, go find who the best retailers are, go visit them, see what they're doing, get on their mailing list, learn what their events are. And I think that's a great way. And then you don't have to copy them. You can tweak it and edit it to something that makes sense for you, but never stop being creative. And that's why that's in green there, because creativity, there's an art and science to retail. This is the art part of it, not just on the buying side, but in how you relate to your customers. And then learn to work on the now and the future. I think probably, we have a luxury men's store that I'm pretty close to the owner, and we were coming out of the pandemic. He was saying, listen, I really want to cut down. We were talking about assortment planning, and he said, I really want to start cutting down on the, on anything that's not a luxury label. And so by the end of 2021 or 2022, I think it was by the end of 2022, we ran a report at 80% of all of his business was now in luxury. And it paid huge dividends in 2023 because he wasn't over assorted. He bought, he got it, he said if a guy can spend, $250, he can spend $400, or, if he was spending $3,000 on a suit, he could spend $4,500. So he really focused on those customers. And then he did something else that I thought was pretty smart. He made all his lower priced items all private label. So he had great margins on them. And if he made a mistake, he could just mark them down and get his cash out quickly. But the result was he had a phenomenal year last year. And as other people's businesses were normalizing, his business started to continue to grow, both from a cash margin standpoint, but also from a growth standpoint, because he really had done a good job assorting and figuring out what his customers wanted. And but that's a good example of thinking about where you are today and what you want to be 2 or 3 years from now. And that's why if you don't have an idea of where you want to be 3 years from now, then you'll never get there, because you need to spend this next year, 2024, working on what do I need to get done in 2024 so that I can be there by 2026, because 2026 will be here before you can, breathe. It just happens so quickly. And then, I just pulled this out of EOS, and what we did as a company, or they continue to do, is break it down into quarterly actions with key metrics that you can measure. And measure the result, because not everything you do is going to work. You're going to have failure, but if you measure it, you know it, and you can move on. But I think one of the big mistakes that small businesses make, whether it's in retail or anything else, is they're always working on the latest crisis. They're always working on the last day of business and what that looked like. And they're really not thinking of taking the time, stepping outside and thinking about, what do I want my business to look like in the future? And then having the capacity to work on both at the same time. And they're both critically important. So I think now we're open for questions. And Matt, do you have any questions for me? I interrupted you enough.
No, I'd be curious just kind of on, like shipping costs is one of the things I think I look at, and we talk about inflation kind of trending down, and a key driver of that is, freight costs are coming down, gas prices aren't as higher. When you kind of think of like inventory levels, do you change because, hey, now I can get more inventory and I don't have to pay as much freight, but oh, wait a second, there's that stuff going on in the Middle East. Do I need to plan ahead of that? How do you kind of plan around some of the uncertainty, and do you move your plans based on economic conditions?
Yeah, I mean, I think those are great questions, and I think shipping costs, when containers tripled in price, prices went up, but at the time, most retailers could absorb the price increase. I mean, the vendors were increasing it, and some price increases were 8, 10, 12, 15%. I mean, in some areas it was as high as 60%, and the customer continued to pay for it because it was on the rebound. As shipping prices began to recede, and transportation costs, then, we began to see that, and it's become more normalized. I mean, I think that all gets rolled up into your IMU, and you have to have an IMU strategy by classification, understanding what's produced here, what you're bringing in. So knowing where your market and where your goods are coming from and being delivered, and having an eye on that is important. And that's part of what a buyer has to look at.
Yeah. You and I talked a little bit about the wealth effect and how that's, I think, a good thing, as we enter 2024. Do you pay attention to the S&P 500 every day, and it starts to go down? Do you pull back on inventories?
No, I don't think retailers think like that.
Yeah.
I think and the market's forward looking too. So
Yep.
I think that if the market's doing well, then you should expect, the market had a crazy end of the year, and it's still continuing to do well. So it makes me optimistic for the next 6 or 9 months. And I would say that overall, if you ask me my view of the business, I guarded optimism. We have an extremely strong labor market. You've got classifications that continue to perform well. I mean, things have normalized. I think Manager One's business overall for all clients was up 3% in December. In October, for the first time in our memory, it was down 1%. And then it turned out to be flat for November. December came back, positively. But I expect, my message to retailers is this: don't sustain what you gained for 2024, and look for opportunities to build on it. And I think if you do that, you're going to have a great year. And obviously, you have a great tool for the Manager One clients, where you can measure that, because I don't own the company anymore, but I've never seen a better progress monitoring tool ever developed for that industry than to look at, to measure the decisions you make. And that small snapshot of a report was just one example. So, use data to make good decisions, and it allows you to take risks. And, the biggest mistake people make is when a mistake's made, they don't stew about it, just respond to it and move on, because that creates the cash to do things. So. So I think we have time from the audience. I mean, I see there's quite a few questions. So
yeah,
Justin,
we have some great questions.
I hope they're all for.
I think we can start off with Lydia Dawson, who asked a great question about whether this info is applicable to Canada. This is something that we've talked about, Marc and Matt, but I think it'd be great to address that on the call.
Yeah.
Yeah, I think on the Canadian side of things, just from an economic perspective, and I'll admit I do kind of lean a little bit more to the U.S. on my day-to-day stuff, but do keep an eye on what's going on in Canada. And candidly, I think Canada is a little bit ahead of the U.S. in terms of they were a little bit ahead in terms of starting to cut interest rates. I think they've seen a little bit more softening in the economy, not as directly, and so I think they've basically been a little bit more ahead of the U.S. But I think directionally, you're seeing some very consistent and similar trends.
Right. And I would say in retail, the same things, that the strategies that I talked about, for the US would be applicable to retail. They're the things that you should be doing. Maybe be a little bit more sensitive to it. I mean, and again, where you buy your goods, I mean, they pay a premium and duty. I mean, there are disadvantages for Canadians. So, they have to be aware of that, and, find ways to overcome it. But, listen, business in Canada is strong. And do you know how the labor market is up there? I'm not familiar with that. do they trend the same as we do? Or I don't want to put you on the spot because we didn't really prepare for that.
Off the top of my head.
Yeah, so something we might want to look into. Thank you for asking the question. We haven't forgotten our northern neighbors.
I hope not. I'm one of them. Another really good question from Zach Whitcamp, which is,
Hey, Zach.
2024 will provide, a contentious political climate, at least in Q4. How are you factoring that into your 12 to 18 month forecast, Matt? Or is it more of a wait and see situation?
Yeah. It's going to be contentious all around. And so I think obviously the focus is on the presidential election. But at the same time, I think from an economic standpoint, it's less relevant. Well, it's relevant who wins the White House, but also, who's in the Senate and in the House. And so I think we have to look at that total picture. I think I think that if you look at it, I think the economy will probably do better if we can kind of sustain a trend. In a sense that, and I put this almost in the context of the Federal Reserve of the Federal Reserve's always got to kind of fight what's going on in the fiscal policy side of things and what the federal government's kind of doing. And so at least the monetary policies kind of reacted to what the current administration's doing. And so there could be a policy shift if that changes. And you have a Trump White House instead of a Biden White House. But I think what I would look at there is I don't think there's going to be any major significant shifts in terms of how that plays into the economy. I think tax changes are off the menu. I think both sides have tended to run deficits, so I don't see a massive pullback there. So I think as we look at the next, I think there's clearly going to be some impacts, but there hasn't been any major policy shifts that would lead us to think it would have an overwhelming impact on the economy.
Yeah, so Bloomberg reported today that they did a chart back in the 1940s, and when an incumbent when an incumbent was running, the stock market actually increased by 13%. When it was a non-incumbent, it went down by 1.5%. I don't know if that's going to hold true this year, or you should buy stocks based on that. But they said the candidate in power had the power to change policy and do things so they could win. So I think that expectation should be, might be expected. From Management One standpoint, I went back and looked at the 2020 election, and there was like a 2-week slowdown in sales, 10 days before the election and a little bit after, and then things just went back to normal. So I wouldn't think the election is a lever for whether you should buy or not buy, or invest or not invest. I don't think it's going to play that. There's a way more hype. We were in Europe in November, and I was a little nervous about going over there. There was a war going on in the Mideast. I didn't know what it was going to be like. What I found is most people only cared about their daily lives. We didn't have any interference or any situations that I ever felt threatened or worried about. People want to, bring home the bacon every day. They're thinking about their own personal lives. So although it consumes a lot of oxygen in the media, I think in people's day-to-day lives, not so much. Maybe the far extremes of both parties, are fully invested in it. But I think for most people, it's just they just want to live their lives.
Well put. We have a really, really good question from Rita Mitchell.
Hi, Rita.
Do either of you see any impact coming into the economic cycles with the demographic talk of millennials inheriting several $1 trillion in terms of money and assets in the next 5 to 7 years?
That would be a better question for you, Matt.
That is a very, very good question. Yeah, I mean, I think there clearly is going to be a generational wealth transfer. And that'll happen continually, progressively, even beyond the next 5 to 7 years. But obviously it is come on the come. I think it really comes down to what are millennials going to do with that? So you inherit money. Is that money that's going to be spent? Is that going to be reinvested? Obviously, everybody will be a little bit differently in that. But what we tend to see is a lot of that money stays invested. But obviously, it leads to people having more wealth. If you inherit some wealth and you feel a bit more confident in your situation, we do think that probably helps the economy. But I think it's at the margin. I don't see it as a significant magnifier, but it's clearly a nice little tailwind when you look at the next several years on that kind of wealth transition.
Yeah, it could also help the housing market too. So, what you and I were kind of talking about the other day, I had asked you about the trillions of dollars that are sitting in on the sidelines in the banks that need to be, could be spent. And, it might have been spun in a way that was higher than it really was, but it's still several $1 trillion.
Yeah. And
that money, once it starts, some of it's going to be reinvested into business. And I think that'll have an effect, don't you think?
I think it will, but I think that it's to some extent it's magnified. Money tends not to move all that quickly, and so it takes even coming out of the great financial crisis, there was elevated cash balances, and it took several years for that money to kind of get deployed in there. And I think there is more money sitting in cash. Some of that's moved out of banks. I'm not sure it really it's money that gets invested. I think it's safety net money. But to your point, Mark, there's no doubt there's more money sitting in cash now that over the next several years we'd see get reinvested. But to put it in context, it's, we have 6 trillion in money market fund balances at present. That's up from 2.5 trillion pre-pandemic. So that's, another 3.5 trillion. That's about 10% of GDP. So that's meaningful. But, if that gets deployed over a number of years, it'll have some impact, but not extraordinary impact.
But that also allows us to have confidence that we have an ongoing strong economy.
Correct.
Because there's money there to invest, to buy, to grow, capital improvements, and those kinds of things.
That's a great point. It does provide stability. No doubt.
We have one more question here from Aya Glasser. I think this one's more geared towards you, Mark, I think. So in Seattle, we're seeing a lot of tech layoffs and high costs that haven't cooled down. Would you change your retail strategy based on that?
So are they more affluent? That's a good question. I think my strategies would stay pretty consistent. I think that my answer to that is you can negotiate against yourself based on a limited amount of data. So I think you got to look into your own database, your own customers, and then look for how do I build new customers? Because if one customer is losing another customer, another vertical is going up, another industry is moving forward. So you might have to shift your thinking. You might have to focus a little bit more on marketing and finding where those customers are. My big worry for retailers is really, you don't really know, everybody thinks they're competing with Amazon, but you're really competing against the people you don't know about, the next person who sees an opportunity to do business in your market or your neighborhood. Which is why you got to be so hyper-focused on your relationship with your customer. But those kinds of things happen in every economy, in every part of the country all the time. I've seen it happen for 40 years of being in retail. And so my answer has always been, shift who you're looking at. You're going to let good customers pass away, good customers move. You always have to be replacing customers. So you've got a certain percentage of your customers that provide a certain amount of revenue for you each year. Be focused on those and growing, those core customers. So focus on the core.
That's a great answer to wrap this up. We don't have any more questions, so we thank you both for joining. I think this has been really insightful. And so, I hope that everyone listening got what they wanted out of it.
So Justin, it's being recorded. So if you want to record it, it'll be on Management One YouTube channel, I guess. And
that's right. We'll be sharing this. We'll be sharing this across the web as well as on all of our social channels as well.
Super. Thank you, Matt. Thanks a million. It's always great hanging out and being with you. Thank you.
Same here. Thank you.